Hi, Abdullah here. I hope everyone is staying safe and practicing social distancing. Above all else, this is a time to put things that we truly cherish into perspective. Freedom, family, life, health. These are things that we take for granted under normal conditions, but with the spread of the virus becoming a pandemic, a global pandemic, um, uh, these things that we've cherished so much come into perspective and they become highlighted, and we should just really take a note of that. Let's all do our part and try to beat this pandemic as a global community. Now, I want to talk about economic cycles and um, the similarities between the 1920s, which led to the Great Depression, and the 2010s, which led to where we are now. There are some key similarities in the way that we are positioned, and uh, I will look to draw on history to show where we should be positioned uh, going forward. Um, Now, history doesn't repeat itself exactly, but it more often than not, it rhymes. So let's get started. The 1920s were classified as the Roaring Twenties. This was a period that brought on technological innovations like mass production. So by the end of the decade, 50% of US households owned an automobile, and also they started owning radios. So these are big technological innovations that change consumer behaviors. Uh, Also, something that was happening was the access to credit. So consumers had a lot of access to credit. They bought cars on credit, radios, other types of consumer goods. They also bought stocks on credit. So they were chasing rising stock prices um, with leverage of over 10 times their equity position. Naturally, this buildup of debt at first is very inflationary. So when people take on debt to buy cars, clothes, other consumer goods, the prices for these goods rise naturally because the demand has risen, the raw materials are demanded. So and at a certain point, this level of debt becomes crushing on the individual and then on the community as a whole, and they start to spend less, which results in a deflationary impact. Now, how did it become deflationary? Was because of over leverage and then where people were positioned. People were positioned aggressively in the market, chasing rising stock prices. When that bubble popped, there was an aggressive drawdown on the Dow Jones Industrial Average. Most stocks got wiped out. So this was an 85% drawdown from 1929 to 1932, and it took around 29 years to recover, to fully recover from that high in 1929. So the first similarity that we see between 1929 and today is market valuations. So this is the CAPE ratio presented by Real Investment Advice. We do a good job of showing market valuations for an very long time frame. So here we see the 1929 market peak trading at 31 times, 31 and a half times, and the 2019 peak at around 32 times. So market valuations were already very expensive before heading into COVID-19 pandemic spread and shutting down of all economic activity. Another similarity between 1920s and the 2010s is extreme income inequality. Here we see the top 10% owning 24% of the wealth in 1929, and in 2008 that picture is the same. Uh, what I'd like to highlight here is that a considerable amount of that wealth had been generated from gains in the stock market, private equity, basically any asset that is more accessible to the rich rather than the everyday working class person. Also, just to highlight another thing, in 2000, today in 2010, 2020, um, most American households don't have $400 to cover for emergency expenses. And that was a similar situation in the 1920s heading up to 1929. In 1929, it was much more pronounced as there was this large burden of debt accumulation. Today, we see a high percentage of auto delinquency in paying down autos, and high delinquency in student debt, as well as average credit card interest rates around 15%, even as uh, interest rates are near zero. This chart shows the size of the investment grade bond market in the US, reaching around 6.2 trillion. Now, the risk here is that triple B, which is the last bucket of investment grade, is around 54% of the investment grade US bond market, which is higher than historical times, and I'll speak to why this is a prevailing risk. There's a real risk here because these triple B bonds have increased their net leverage from 1.6 times their earnings to around 3 times their earnings. That means they need around 3 years of their of operating income to pay down that debt. That's excluding taxes and any interest that they have to pay. So the problem here is that this could have a, a spillover effect onto the rest of the economy. So in that triple B bucket, you'll have companies with recognizable brand names like General Electric, Boeing, AT&T. These companies have not witnessed much growth over the last 10 years, yet we've seen that their debt profile has increased markedly. And what have they done with all that debt? Most of them have bought back their share price. So they haven't invested in productive assets where this would create growth and job creation in the future. Rather, they just artificially propped up their stock price. And today they're feeling the effects of this. So, for example, Boeing had a terrible performance in 2019 because of malfunctions in the way they designed their planes, and they were looking at an overall business restructuring. So this pandemic couldn't have come at a worse time, and today the government is talking about a bailout for Boeing. Now that could come with a lot of political backlash because what they were doing was it wasn't beneficial to the overall society, and now society is having to pay for those mistakes. Um, uh, and the big problem is that when a company finds itself economically crippled, the first thing that they do is they lay off workers, which could have a spillover effect on the rest of the U.S. economy, hurting the service and the consumption sectors even worse, which could be an even worse crisis for the US and possibly the globe. So, what happens usually in a market crisis or in a liquidity event is that investors start to sell off their holdings, and some of these holdings include corporate bonds. When they sell off these bonds, the yield on those bonds increases, which basically means that the spread on, even as the Federal Reserve cuts interest rates, the cost to borrow for these corporates rises and rises substantially. Amid the 2008 crisis, we saw a substantial rise in the option adjusted spread, around 6.5% above risk-free rate. And then in 2020, recently, we've seen a similar spike. Today, we see that the Federal Reserve is stepping up and looking to stabilize the financial markets with their largest round of quantitative easing yet. Today, the balance sheet is around $4.4 trillion of assets, and these assets are U.S. Treasuries, and there's talk that the Federal Reserve is looking to buy corporate bonds. So that has stabilized the cost of borrowing for U.S. bonds. In the meantime, we'll see how this develops further. So what does the Federal Reserve usually do in times of market stress? It does quantitative easing. It prints money and lowers the inflation rate. They did that in the 1930s, brought interest rates down and increased the money supply by around 10 to 13%. In 2008, they did this on a much larger scale. So they were talking about QE1, QE2, QE3, QE4. Where the amount of money printing was so high, and yet it wasn't. It could be argued that it wasn't very successful in bringing on inflation, because all that excess, all those dollars being printed, did not find its way down to the to Main Street. Rather, it stayed with the corporates who bought back their shares. So you could say in 2008. The quantitative easing was successful in inflating the stock market. It was successful in inflating real estate and corporate bonds, but it wasn't very successful in bringing on inflation, which was the main objective. Today, a key difference between the 2010s and the 1930s is that today inflation is a global issue. So the US Federal Reserve, European Central Bank, Bank of Japan, China, Australia, they're all doing this, and they're buying their own government bonds in an effort to devalue their currency and ease that burden of debt on the affected sectors. So today we have an unprecedented $15 trillion in central bank assets for which they've bought their government bonds, basically. What what uh, what what these central banks are trying to do is to devalue their currency and decrease interest rates to make it easier for those who are stressed to be able to restructure and to ignite economic activity. The key problem here is that these banks are trying to devalue their currency against their trade partners. So when other trade partners are synchronizing buying government bonds, and they're all in global debasement synchronization, so they're all trying to debase their currencies, you end up with a very limited net neutral effect on currencies. However, the world's reserve currency, which is gold, has been for thousands of years, and I think it continues to be so, appreciates very well against currency devaluation. So when investors see that the global monetary system is being devalued, being debased, usually gold acts as a safe haven. And I would argue that gold should be a holding in every investor for every investor as a good diversifier. This is on the top is a long-term chart from the 1920s until today. and we see that there is a strong negative correlation between long-term rates and gold. It's not perfect. Sometimes that correlation breaks down, but overall still appears to be a very strong one. If we if we zoom in to 1929 up to 1940, the economic crisis hit in 1929, and initially gold didn't do too well. So gold drew down, and long-term rates were actually rising. So the Federal Reserve was very late to cut rates, but when they did cut rates, um, gold did fantastically well. So gold appreciated from around $16 to $35 an ounce. We see a similar situation in the 2000s. So if we look at 2008, where the crisis hit, the Federal Reserve cut interest rates and continued on a downward trajectory of cutting interest rates. Well, that was very positive for gold. Gold went from um, around $900 to around 1600 today. Um, if we go back to the 1920s and we look at what the stock market did, uh, the S&P 500 drew down, but then it had a short relief rally, which is something that we're seeing today. So here is the 1 year chart of the Dow Jones Industrial Average compared to gold. We see one of the fastest drawdowns in market history right here. And then amidst this drawdown, you see a small recovery around 20%. So for, around 40% down in less than a month, and around a 20% rally within a week. So we're witnessing huge bouts of volatility, and markets are much more volatile than they were in 1929. This can probably be explained by market integration and how the financial markets are much more integrated than they are before. And similarly, you look at gold and you see something similar that happened in 1929. When the crisis first hit in 1929, we saw that gold didn't do so well. And as we're looking here, we're seeing the same the same patterns emerging. So gold sells off with the market, but then recovers massively based off the fact of uh, the government and the Federal Reserve stepping in. The government with a $2 trillion program to arrive to Main Street and corporate America, while the Federal Reserve is looking to stabilize the financial markets through QE5. And within this program, this is going to be much larger than the 2008 quantitative easing program, where they're looking to expand their mandate to corporate bonds. Now, we'll see how that develops, but in my opinion, going forward, I'm quite bullish on gold as the government and the Federal Reserve and key currencies, key global currencies look to devalue their currencies, given that they are experiencing very large debt burdens. Governments are experiencing very large debt burdens and no growth. I think that should be a very positive setup for gold. That's it from me. Thank you. I'm sorry I took around 20 minutes of your time.